Hi, welcome to Retiring Well. Folks, we got a great show lined up for you today. We're going to talk about tax planners versus tax preparers, Roth IRAs versus traditional IRAs, what is systematic risk, what qualifications should you be looking for in an advisor, and finally, we're going to talk about ABLE accounts. What are they? They're actually for special needs people, so stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, welcome back. Now listen, in this segment, I want to talk about tax planning. All right, now there's a big difference between a tax planner and a tax preparer. The best way for me to illustrate this is think about tax season. When do you have most of your income tax documents? Wouldn't you agree that whether you open up the mail that says important tax information or not, that mostly everybody's got that by at least the middle of February, right? And then I can tell you that most people like to have their taxes done by April 15th. So if they're getting most of their documents by middle of February and they want it done by April 15th, how much time is that for most preparers to get all the tax returns done? Literally only 2 months. Now think about that. How much tax planning do you think they're doing in that 2-month period? Now, I had my own tax and accounting practice for over 25 years, and I can tell you during that 2-month period, I was just trying to get taxes out the door. I used to pride myself on giving people, advice, maybe looking at some observations, maybe showing some things they could do to save money. But the kind of tax planning I'm talking about, running mock returns and strategizing and that kind of thing, wasn't happening in that period. So a lot of people think they've got a tax planner, but really all they got is a tax preparer. Now, what's involved in income tax planning? Now, for most people that we work with, soon to be retired folks, the kind of tax planning we're talking about is really tax bracket optimization. If somebody's got Social Security income, maybe they got pension income, maybe they got part-time employment, maybe they still got wages, and now they have to take money out of the IRA, that's right on top of all that other income. What bracket do they find themselves in? And if there's any room in that bracket, that is a great opportunity to do what's called Roth conversions. That the idea that we're going to pay the tax on the IRA and convert it over to a Roth IRA. Now, let's say I'm in that, let's say 22% tax bracket. I'm always going to be there based on all my other income, and I know when I take money out of my IRA, it's going to fall in that bracket. What I'm conceding is that Uncle Sam now has got a 22% interest in my IRA. I have a partner in that account. So knowing that if I've got any room in that bracket, why would I not go ahead and accelerate money out of the IRAs, convert it into a Roth, pay the tax on it at the 22% rate, and convert it, because I'm basically going to pay that no matter what. If tax rates ever go up in the future, well, guess what? I've saved, I've got it out of there early, growing in a Roth, tax deferred. Now, IRA exit strategies is another thing. How do I get that partner out? Well, Roth conversion's one way. How about life insurance? If I know Uncle Sam's going to get 22 cents on the dollar, what if I had a life insurance policy there to pay it off Uncle Sam, when the first spouse died? So tax planning, there's a lot involved in it. Encourage you, if you're somebody that does not have a tax plan and you want one, then give us a call. We'd be glad to sit down and see if you're not a Roth conversion candidate. Hi, listen folks, I want to invite you to a virtual live event. We're going to hold it April 20th at noon and 6 o'clock. We're going to talk about what is the state of affairs as we find ourselves today. 2020 with the pandemic, and now we're in 2021. There's a vaccine rollout. Where we stand today, where are we going? How should you position yourself to better be prepared for the situations we find ourselves in? So I'm going to encourage you, don't miss this event. Sign up. You can register online at cen-wealth.com. We'll see you there.
We look forward to helping you plan to retire well.
Hi, welcome back. Listen, in this segment, I want to talk to you about IRAs and Roth IRAs and kind of some of the main differences between the two. When you put in or contribute to an IRA, you get a tax deduction, okay? That means you're not having to pay tax on that contribution. And you get what's called tax deferred growth, meaning it's that money in that IRA is growing tax deferred. You're not having to pay tax on that. But by the time you get to the distribution phase, now it's fully taxable, because you have to understand this is money that's never been taxed. And so now as you take out, Uncle Sam's there, they want their share, okay? In a Roth IRA, it's a little bit different. You're putting in with after-tax dollars, meaning you're paying the tax on the money going up front. But like an IRA in the sense that you get tax-deferred growth, okay? It's going to grow and you're not going to have to pay tax on that part. But the beauty of a Roth IRA is once you get to the distribution phase and now have to take money out, it's not taxable. Okay? Now there's some qualifications that you have to reach in order to take the money out, but once you get to that retirement age and you're pulling out, it's going to be tax-free. Highly advantageous, right? Especially in tax planning. Now, the concept would be if I'm in my working years and maybe in a high income tax bracket, having that tax deduction is highly beneficial, so I might want to be more apt to put into an IRA. All right. The idea being that I save at this rate and then lo and behold I might be in a lower bracket later on, maybe when I retire, so I save at this rate, pay at this rate. Highly advantageous. But if I'm a younger taxpayer, maybe I don't have that high income yet, I'm just kind of building up my career, I'm already in a low bracket, maybe a Roth IRA might be more advantageous because, you know, again, with a Roth IRA, I don't need to save at that high rate. So I'm in a low bracket, probably going to be in a low bracket by retirement. So I don't need that tax deduction. But what I do want, I've got all these years that I can have that money grow tax deferred so that when I pull it out at retirement, now it's tax free. Highly advantageous maybe for that person. Now, there's a lot of what you call 401ks out there. Okay, these are company plans that the employer puts into and the employee can put into, right? Now, a lot of these plans will have features where they have a pre-tax method and they have a Roth IRA option that you have available. It's important to understand that the employer portion that goes into those plans, the match as they call it, that has to go into a pre-tax plan, meaning it has to be where you don't have to pay tax on their contribution, so that's go pre-tax. But you have the choice of picking pre-tax or Roth IRA. So maybe for somebody like you might want the company put their part in, their match, but you put into a Roth IRA part, especially if you're in that low bracket. Now, folks, you know, understanding the difference between an IRA and Roth IRA is very important. I mean, a Roth IRA is really nice once you get to retirement, especially in tax planning. So if you're somebody that's got, you know, got some of these monies and maybe those different buckets and you want to see which one might be more advantageous to you, then I encourage you, give us a call and we'll help you through that.
Wow, what great timely information here. Tax season is probably concluded for most of you out there, and hopefully you didn't wait till the last minute, but as we know, many folks do. But here, Larry talked about a couple different forms of tax planning, tax preparing, and also got into IRAs and Roth IRAs, and they all kind of dovetail right together. You know, the thing that makes me when we go through all these folks, we talk about retirement tax planning even versus more traditional tax planning. For the younger folks out there, it seems like every year you're trying to think, well, how can I pay the least amount in taxes year to year? How can I kick the can down the road and pay less in taxes? But in retirement tax planning, John, it's quite a bit different, right? We want to maybe accelerate or pay more taxes now so there isn't potentially a growing looming tax bomb down the road. I know you worked with some folks recently that they were looking at that.
Yeah, and Art, it can be a little painful as you're thinking about paying taxes now versus paying them later, but just sitting down with a couple recently and they were in a position where they'd been retired for some time. They'd never really thought about tax planning, and so here they were continuing to grow their IRA 401k accounts, but they are at that stage where they're over age 72 and so starting to take those required minimum distributions, but they were saying, well, we don't really want to take that money, we don't necessarily need that money, but we ideally want to leave maybe as much behind to our family as possible. And so we started going down the path of looking at what their tax ramifications are today and their current levels, and we found they basically still had room in a certain tax bracket where they could be transitioning money from traditional IRA 401k over to Roth. And so again, it just becomes a valuable planning tool to be looking at year in and year out. I know that's part of our team approach here at Centennial Wealth Advisory, is to have that tax planning as part of the annual process. And so again, it's something very important to be looking at and considering for your retirement planning strategy.
And that's very important what John said there. If you're not looking at this annually, or you don't know what your potential tax liability is down the road, that could be a problem for you. You could have an underlying issue there that could really raise its heads and cause a problem. So if you'd like a free review of that, a second opinion of not only your investments but your tax situation, give us a call at the number on the screen. We'd love to sit down with you, walk through that with you with a no obligations free visit. Coming up next, you're not going to want to miss this. Larry's going to talk about systematic risk and how that could affect your retirement.
When does a Roth IRA conversion strategy make sense? Call or email us to request the Wealth Report on Roth IRA conversions to help you plan to retire well. Find out what the Roth IRA conversion rules are and what scenarios are beneficial from a tax perspective. There's no cost and no obligation to receive this informative report. Simply call 888-608-5825 or email us at info@cen-wealth.com and request your copy today.
At Centennial Wealth Advisory, we specialize in retirement planning. Folks, we put a show together every week that we talk about a number of financial topics that are critical in your retirement planning, from tax planning, estate planning, income planning, long-term care, health care planning, and investment management. If you missed the show, then you just visit our website, go to the media tab, and you'll see the latest show. Have you ever heard that saying, all ships rise and fall with the tide? Well, in our industry, this is what we call systematic risk, or beta, which I'm going to explain here in just a minute. So here's the idea. Let's say that I'm in an index fund that's tied to the S&P 500. Okay, this is an index fund that basically owns the S&P 500. Now, if I'm comparing that with the benchmark itself, or the index S&P 500, you would expect that index fund is going to go just like with the market, right? So if you see the S&P 500 rise, 2-3%, you're going to see that index fund rise 2-3%. For the most part, right? Think of a mutual fund that's made up of large company stocks. If a large portion of those stocks are the S&P 500, you would also believe that if the S&P 500 went up 2-3%, that most likely that mutual fund invested in the same would rise about the same. This is what we call systematic risk. The idea that that your portfolio is going to be pretty much going with the market. Now, that's a good thing if the market's cooperating. If I see the market do well, and I'm watching that benchmark, I know my portfolio did well, right? But what if it's the opposite? What if I'm watching, the market going down? I could probably expect my portfolio to be going down right along with it. Now, the ideal thing would be to have it go up with the market, but not have it go down with the market, right? Now, we have the ability to get behind any portfolio and actually find out what its beta is, okay? B-E-T-A. What it is you take a beta of 1.0, and that means that portfolio is basically going right with the market. If the market goes up 2-3%, you can pretty much expect that portfolio to go up by 2-3%. If it's down by 2-3%, you should expect it to be down by 2-3%. Now, a beta score of less than 1, okay, maybe you say it's 0.8, means that it's going to be less riskier than the market. So market's up 2-3%, yours should only be up 1-2, all right, and vice versa on the downside. Now, a beta score of 1.0 or more means that the portfolio is more riskier than the market. So it's going to possibly do even better than market, but probably do even worse than the market. So knowing the score is very important, because if you have a well-diversified portfolio and at the end of the day it has a beta score of 1 and it's pretty much just tracking the market, well, if that's what you want it to do, that's a good thing. But if it's on the downside, if it's not what you want to do, maybe that's a bad thing. So I encourage you, if you're somebody that doesn't know that score, doesn't know how your portfolio would operate as it's compared to the market, then give us a call. We'll gladly analyze that portfolio and tell you what your beta score is.
Professional golfers have a game plan. Knowing where to attack the golf course is vital, and avoiding the hazards is key. As you can see, we aren't professional golfers. But at Northern Michigan's Centennial Wealth Advisory, we are professional financial advisors. Give Centennial Wealth Advisory a call or visit us at cen-wealth.com and let us help you plan to retire well.
Qualities to look for in an advisor. What are they? Well, the first one you want to have in that advisor is experience. Folks, this is very important. When I first got involved in financial services, it was in the late 90s, and I'd never experienced a down market before. All of a sudden comes along 9/11, 9/11, it's 2000. I watched the market drop to almost half its value in a 2.5-year period. That was very important for me to have to experience, because in all my training, they talk about market volatility, but I had no idea the markets could be that volatile. And so having the experience of having to have a walk through that was very, very important. 2008, the credit crash. Another time, it dropped to almost half its value. This time only in a 15-month period. Very important for me to have to live through that. Now, by that point, I was much more experienced because I'd already experienced a market downturn. So I, knew they could come along. I knew the risk people were taking, and I had them positioned appropriately. So having the right experience is very important. I remember as a young man, the only time I said experience didn't matter was when I didn't have any, right? So very important to have that. The next thing you want to look for in an advisor is, do they really have your best interests in mind? Now, this is a little harder to determine because, if they're trying to sell you something, they're obviously giving you all the positives of what they're trying to sell you. But how do you really know they have your best interests in mind? The best way I think you can tell is know the kind of questions they're asking you. Are they really, really concerned about what you need or want? And you can tell by the questions they ask. If you walk in and all they do is start talking about what they do and how they do it, and this is why we do it, but they never ask you anything about yourself and how you feel about things, what experience maybe you have, maybe some experience that you had where the market dropped to half its value and you said, hey, I don't ever want to see that for me. So you can kind of tell by the way they kind of ask the questions and whether they're really listening. The other thing you want to maybe look for in an advisor is, are they independent or not? Are they just selling one company's products? If they're just selling one company's products, they're probably not going to be independent, meaning they're really trying to just push that one product. But if they're independent, maybe they can sell from a vast array of financial companies with a vast array of financial instruments. More likely, they're going to be more independent, aren't they? Because they're not just selling one company. The other thing you want to look for is communication. Are they regularly calling you, talking to you, or educating you on what's going on in the markets? Very important. Number one complaint we get with people coming in to our offices, they didn't call me, they don't talk to me. So very important that they communicate with you as well. Hopefully these are all good qualities you want to look for in an advisor. Give us a call if you're not getting that. We'll show you what we're doing, how we're doing it, most importantly what you want, so we can help.
Really valuable information that Larry shared. And Art, when we talk about that systematic risk and ultimately matching up clients' portfolios, it's interesting. I've been doing this for 16 years now, and when people come in and we talk about, hey, where's your comfort level with risk? And so often we find, well, I only want to be taking on this much risk, but then we're able to run an analysis on the portfolio and basically say, well, just so you know, you're taking on this much risk. And so it's really important to know where you are and what your level of comfort is when it comes to your retirement plan.
You know, you're right, John. I mean, I think with the market done so well really since 2008, you know, folks, I think, have almost lulled into believing that they have less risk than maybe they do, especially when they hold some of these index funds and they're primarily in equities. We've been fortunate to have a pretty good run. Now, they got a little bit of an eye-opening back, you know, March of 2020 with the pandemic, but then quickly it rebounded and gone from there. So I think, you know, we've had this false sense, and that's going back to us as advisors have to make sure we're doing a good job, making sure, as you said, understanding what your risk is, walking through that, and do your investments really match what you want them to do? When I was sitting down with some folks recently, they had just started retirement and they had this 401k that they had been putting money into for years, and there kind of was this false belief that that was their retirement plan, you know, that they just had this group of investments and forevermore that was going to meet their needs. Well, guess what? As an advisor, when you're looking for an advisor, there's much more. You know, John, communication is big, right? I mean, we're talking to people all the time, right?
Yeah, for sure. And that's one where during the pandemic, we were previously doing quarterly market updates. We increased that to doing monthly market updates just to keep our clients informed of what's happening, because things are rapidly changing. And that's so important. It goes above and beyond just the investment piece. I mean, when you're looking for advisors and looking for ones that want to know more about you and specifically what you're trying to accomplish, it comes way outside just the investment piece. There's a whole slew of things to be talking about: your income planning, tax planning, as we talk about a lot on the show, estate planning, insurance planning, all those different areas we see necessary to come together as one.
And that's absolutely right. If you feel like you're not getting that where you're currently at, or you haven't had a communication with your advisor, give us a call. We'd love to talk with you, talk through how we may be able to help, and let's figure out what your goals actually are for that money. It's more than just a pile of money. It's your way to do all the things you want to do in retirement, provide for yourself and maybe your family, and how is the best way to most efficiently accomplish that. If that's something you would like to do, give us a call at the number on the screen. We'd love to talk to you and your family and how we can potentially help you plan to retire well.
Hi, listen folks, I want to invite you to a virtual live event. We're going to hold it April 20th at noon and 6 o'clock. You know, we're going to talk about what is the state of affairs as we find ourselves today. You know, 2020 with the pandemic, and now we're in 2021. There's a vaccine rollout. Where we stand today, where are we going? How should you position yourself to better be prepared for the situations we find ourselves in? So I'm going to encourage you, don't miss this event. Sign up. You can register online at cen-wealth.com. We'll see you there. Okay, in this segment, I want to talk about what's called ABLE accounts, A-B-L-E accounts. Okay, now these are 529 counts. Now 529 is just the IRS tax code number for when this account got created. But it stands for Achieving a Better Life Experience Act. Okay, now this is for disabled kids or people that you want to, that can have savings. And let me just explain some of the details. First of all, anybody can save for a disabled person. It could be a grandparent person or unrelated person. So anybody can save for this disabled person. Now, the disabled person has to have been diagnosed with this disability before the age of 26. Okay, so it's not for somebody that got disabled after that age. They had to have been diagnosed before the age of 26. Now, that person that's disabled can still be receiving SSI, Social Security, and Social Security disability. Okay, and they can still have this savings, and this savings does not count against that income. Okay, if you have a disabled child or know somebody that's disabled, you know that they can only have so much in their account and before it starts to affect, you know, their Social Security disability. With these ABLE accounts, they're able to save up to $100,000. Okay, and that $100,000 can be used for, you know, anything from medical to education to tutoring and all kinds of things. So this is a great way for somebody to save, you know, have a lot in savings and have it be there for them somewhere down the line and not affect their disability. Now, when you put money into these accounts, there's no tax deduction for doing so. You're limited to the annual gift exclusion every year. Right now, as of this airing, it's $15,000 that you can gift somebody without having to file a gift tax return. So you can give up to $15,000 per year and save up to $100,000 in these accounts for that disabled person. Now, it used to be to have an account like this, so you had set aside for that disabled person. We had to use what was called a special needs trust. And basically how those work, and matter of fact, you can still use a special needs trust if you find it appropriate. But what they do in these trusts is it's an amount that you can have there for the disabled person, but it's not, they don't own the assets in it. So the money can be used for their benefit, but it's not in their name, so it can't count against them for SSI or disability. So in some cases, these ABLE counts might be useful. If it's going to be less than $100,000, that'd probably be the simpler way to do it. But if you obviously you wanted to save a lot more for this disabled person, let's say it's an inheritance or something, you're probably going to want to use a special needs trust, which means you're going to be talking to an attorney to set it up. So hopefully you found this valuable. It's a lot of people out there don't even know these accounts exist. So if you do have a disabled child or know somebody that you want to put some aside for, then obviously this is something you might want to do. If it's an account you want to set up, give us a call. We'd be glad to help you with it.
Wow, probably a topic that maybe you haven't heard about, or hopefully you learned something there. I know that's maybe not for everybody, but it really touches on the importance of holistic planning for everybody. You know, there's really specific things out there that can help folks in many different situations. And if you'd like to find out if that's you, that's all the more reason why we always encourage people to give us a call, come in for a free consultation, and walk through and see what makes sense for you. Whether it's one of these ABLE type accounts, or maybe it's something else. You know, a lot of this talks about estate planning and how important that is. And everybody really needs to have that plan. Having a holistic advisor on your side really can potentially help better your situation long term so you can have the retirement of your dreams. Now, John, I know you have very familiar with this type of situation. You know, why don't you talk a little bit about that?
Yeah, it's something where my parents are helping out my aunt, and so they've coordinated all this through a qualified estate planning attorney who's very knowledgeable in the special needs trust area and how valuable that can be to make sure that you have those professionals that are helping you through that process, because there's a lot of information to know and you want to make sure that you're on top of it. And so just as Art mentioned earlier, here at Centennial Wealth Advisory, our goal is to help work with you on all of those different areas, and there may be certain things that you're not aware of that maybe we could shed some light on. So we're hopeful that you found this information helpful, and as always, we appreciate you tuning in to Retiring Well, and our goal as always is to help you plan to retire well. Feel free to give us a call anytime. We'd love to sit down and talk.